Good afternoon, everybody. So this is handout 17B. I think I gave some of them out in class. So you guys probably have it, but if you don't, I'm just gonna leave a couple copies here, and you are welcome to. So that's one. Oh, you got one? You got one? Okay, you're good. Yep. It's the one that I hand wrote student on top of it. Okay. You probably have it, Ethan. I hand wrote student on it, the one that we're going to be talking about. The sheet that I gave out on Tuesday. Oh, okay. The 17A was just the practice questions and the kind of use it for your test. And then 17B is the practice questions. Is anybody in here graduating December? Did I hear yes? No, okay. They just wanted us to get your info if you were. What's that? Jamie, okay. I'll send it out to her. All right, so ready to jump in here? And Jamie is okay. All righty, so everybody's got this. Go ahead and walk through example one. And they're asking, this is related to kind of subsequent events. So it's preparing its December 31st, 2025 financial statements. Usually are doing that in the next year. So we're in 2026 and they're going to be released on March 10th, 2026. So we have these two things and we want to know what effect does it have on the 2025 net income. So it says a liability estimated at $160,000 on December 31st, 2025 was settled on February 26th, 2026 at $170,000. So while this doesn't really appear, material, we'll assume it's material here. And so this would result in net income decreasing by $10,000. And this is because it is related to 2025. It happened then. And it was settled before the financial statements were published. And then the last one would be no effect. Could disclose if material. Okay, and I'll leave that up. And then you guys have practice questions. And I'll tell you, they're tough. Take like 3 minutes, read it slow, go through them and try it. I got a 60. So don't feel bad if you don't do as well, do well. Yeah, just practice one. Was everybody able to get the full explanation there? Good. That's when like the government says it's mine. So like what happened in Venezuela a few years back? I could be wrong. That's a big word. Okay. So this was tough. I'll admit I got a lot of them wrong, and it was between the B's and C's where I wasn't really sure. And one of the things is you kind of have to assume, okay, in this case, it's all material. So it's like, all right, what do I figure? So settlement of prior year's litigation against the company at no cost. So this happened after the balance sheet date, but before the financial statements were released. And so this is A. Because it's prior year, it's the only one in this case that we're going to be going back to the prior year for all of these. Okay. Sale of 10% of company assets, that would be B. Acquire a significant company would be C. Number 4 would be B. Number 5 would be B. Number 6 would be C. Number 7, B. Number 8, C. Number 9, C. And 10, B. Any questions? It's tough, and it's really between what do you disclose and what do you not have to disclose. The adjustment part's easy. If it's prior year, then you adjust it. If it's not, then you don't worry about it. Example 2, determine which of the operating segments are reportable based on the following. So the revenue test equals those that exceed 10% of revenues. And so here, 10% of 398,000 equals 39,800. So we have A, B, and D. Now, the one that's a little bit tricky is the operating profit and loss test. And this one is going to be 10% of the positive operating profit in absolute value. So here, operating profit, you take 10% of 26,500, and that equals 2,650. But we have to add back the 5,000 plus the 2,000 times 0.1. I'm looking at my answer sheet. Sorry. Add the 26,500. I don't want to take the 10% first, confusing myself. To the 8,000 plus the 500, and that equals 33,000, sorry. And then now I'm going to multiply it by the 0.1, and that's going to give me 3,350. $26,500 right here. Oh, duh. Thank you. 25,000 to 8,000 plus the 3,000. Yes. By the way, Carter is by far the smartest student I have ever had. And I so appreciate it. This first year through, when I make little mistakes, he always catches them. And so I want to thank you, Carter, from the bottom of my heart. And it doesn't cost much. I'm available for parties. So 3,350 is the number. And so now we have to look and see what exceeded that. So we have A, B, and C, because it's the absolute value. And then identifiable assets. And again, this is 10% of identifiable assets. And so 10% times 361,000 equals 36,100. And so here we have A and D. This might be very similar to one of the questions on your test, so, I want to pay attention. Any questions there? Okay. Example 3. And I'm going to go over to Excel. And so it says each of these companies has requested a $200,000 loan for 6 months with no collateral offered. So it's an unsecured loan. Since your bank has reached its quota for loans of this type, only one of them can be granted. So we have a few things, right? We have a loan, and what's the term of it? 6 months. So when you're assessing a company's ability, you want to assess their ability to pay a short-term loan, right? So the way that the textbook wants us to go about this is, of course, looking at our current assets versus our current liabilities. And so what I haven't seen done before, but is okay to do in either way, is try to look and see, compare what you have for cash, receivables, and inventories as a breakdown as part of your current assets. And then, of course, we care about current liabilities. So these are going to come into our calculations later. We're not so worried about long-term liabilities because if they can't get past the first part, then there's no point in loaning them something long-term, right? And so you guys understand that this is 26% of total current assets. All right. And now they have us calculate a few ratios. One is the current ratio, which is your current assets versus current liabilities. And so here, we're going to take our current assets and we're going to divide by our current liabilities. And this is not dollars, that should just be 3.46. Okay. And then we can make that same calculation for the other company, McCoy Company. And then we have the acid test ratio. And the acid test ratio is current assets less inventory divided by or versus current liabilities. And again, that's just 1.46. And when you read these, you'd say 2, 1, 1.36 to 1, right? For every dollar of current assets, we have $1 of liabilities. What other ratios might be helpful based on what we've seen? Well, we see that they've got accounts receivable, so we might want to look at the AR turnover. I didn't write down what this was, but I think this is the piece that we need. Oh, rate of gross profit on sales. Here, and this one says annual sales. And so this is annual sales. Oops, or sakes. Man, that was terrible, huh? Divided by, I believe it's your AR. Yep. Divided by AR. And so here, our annual sales 1.3 million divided by our accounts receivable. So that means that they're turning over their AR faster. They're collecting it faster. And they're turning it over more often. So this is like once a month, and this would be just a little bit less than once a month. Okay, and then inventory turnover. I think that's cost of goods sold. Yep. To inventory. So this would be cost of goods sold divided by inventory. And so to find cost of goods sold, multiply sales by cost of goods sold ratio. Or by the gross profit, 1 minus the gross profit ratio. So our gross profit ratio is 35%. So 1 minus 35% gives us 65%. And so that's our ratio. And so we have sales. And so our cost of goods sold would equal your sales times the ratio. Okay, so now that I have the cost of goods sold, I take cost of goods sold and divide by inventory. So I have 845,000 divided by 505. And 4.4 times. So McCoy is moving more inventory faster, right? It's turning over its inventory faster. It does have a smaller inventory. And so that's what that tells us. And then the last thing they suggest you look at is cash to current liabilities. And so here we're just taking our cash and dividing it by our current liabilities. Okay, so now we have to look and say, all right, what's a better credit risk? So, which is better? And so let's take each of these. So we have the current ratio. And so in this case, the first company is Era. Okay. Acid test. Which one does McCoy have the better ratio? And so far, so we've got AR turnover. And we know Era has the better ratio there. And then we have inventory turnover. Here. And then cash to current liabilities. And we got this one. So in your analysis, whenever it asks a question like this, and you're not going to have anything like this on your exam, don't worry about it. This is just kind of going forward. When they ask you about specific things, you want to comment about each of these. So you'd want to say Era has the better current ratio, which means they have more current assets to pay current debt. For acid test, Era has the better ratio. Removing inventory from that calculation still shows they have the better ratio. AR turnover shows that they're collecting it roughly within 30 days or once a month. And so their collections are better than McCoy's. Then you could say something like McCoy does have less inventory, so that's a little bit less risky, and they turn theirs over faster. And then cash to current liabilities. Era right now has the better cash to current liabilities. And so overall, we think Era is the less risky of the two. Okay, any questions? Okay, practice 2. Now this is going to be for you guys to work on. And they want to know current ratio for fiscal years 2025 and 2026. And so I've got all the numbers up here. And this, I think if somebody wants this, I'm going to put it out there. If you don't want to make them yourself. What's that? Yeah. Hey, won't you go? Oh, that stupid, this thing right here. I saved it. So that's out there. If you want to take a minute to pull it down, you don't have to. I'll help you do some of the stuff that's easy. So it says, compute the following items for Montana Corporation. You have current ratio for both years, the acid test ratio, the inventory turnover ratio. So we've talked about those three. Return on assets. So I think their ROA calculation is going to be the beginning assets. Okay. Net income divided by average total assets. Okay. So plug away. And just for the record, that notes payable is considered current. The way you would discern that from the fact that it's not given to you is that it's between accounts payable and accrued liability, which are both current liabilities. How are you guys doing? Plugging away still? Okay. We got plenty of time. I think I told you we'd be out of here in 45 minutes. So we're close. Bless you. Excuse me. And the prior year's total assets were 2,200,500. Because how did that work out? Oh, really? I made a math error somewhere here. Oh, all right. Ready to walk through? Okay. So current ratio, I get 1.97 and 2.18 to 1. The acid test ratio, I get 1.32 and 1.47 to 1. For inventory turnover, I get, oh, this says take average cost of goods sold, and it just wants it for 2026. So if you guys did that properly, I get 9.88 or 9.9. And then return on assets, I get 12.83 and 12.9. And then your percentage change in sales. So this, by the way, is your current year minus your prior year divided by your prior year. That's the base. And so that's what I got. Any questions? Well, if there are no questions, you are free to go. I would like to thank you. You guys have been so active and so participatory and keeping up with your work. I really appreciate it. You guys ever need anything from me, just shoot me an email and I'll be happy to help. You guys have the exam part 4 left for chapter 22 or 23, excuse me. And then you'll see the chapter 23 in class group work is really easy. Thank you very much and congratulations. You're done with intermediate accounting. Thank you, everybody online. I'll see you guys later.